In the world of finance, there's this really powerful idea that markets are perfectly efficient. But what if that whole idea is built on a fundamental flaw? Well, today we're diving into a paper that exposed a deep, deep paradox right at the heart of that theory. So, for decades, the big idea was the efficient markets hypothesis. And it's a pretty elegant concept, right? In a competitive market, asset prices are supposed to instantly absorb and reflect all the information that's out there. Every news story, every analyst report, poof, it's all baked into the price in a split second. And what that really means is there are no easy profits, because by the time you hear the news and try to act on it, the price has already moved. But then, in 1980, two economists, Sanford, Grossman and Joseph Stiglitz, came along and asked this brilliantly simple and totally devastating question. They said, hang on, if a market is perfectly efficient and the prices already reflect everything, why would anyone spend their time, their money, or their effort to go out and uncover that information? There's just no reward for doing the work. And that single question, it just blows a massive crack in the whole foundation of efficient market theory. This is what we now call the Grossman-Stiglitz paradox. The key insight is that information isn't free. It costs real money to hire analysts, it takes tons of time to do research, and you have to put in actual effort to find some kind of edge. This creates this perfect circular trap that just defeats itself. Let's walk through it. First, if markets are totally efficient, you can't make a profit from new info. Okay. Second, if there's no profit, there's absolutely no reason to pay to get that info. Third, if nobody is gathering information, then how can prices possibly be efficient? They can't. Fourth, inefficient prices, well, they create profit opportunities. Fifth, those opportunities give people an incentive to go out and find information. And boom, you're right back at step one. It's a complete logical contradiction. The authors really nailed it in their paper. They said that the idea that markets are always perfectly arbitraged is just fundamentally inconsistent with the fact that arbitrage, the actual work of finding and acting on information, costs money. You just can't have both of those things be true at the same time. So, if perfect efficiency is impossible, what's the alternative? Well, Grossman and Stiglitz didn't just point out the problem, they proposed a whole new model to fix it. And to understand it, we need to meet the players in their version of the market. They basically imagined a market with two kinds of traders. On one side, you have the informed. These are the people who pay the price, literally, to do the hard work of research. And on the other side, you've got the uninformed. They don't pay for research. Instead, they just watch the stock ticker, trying to guess what the informed traders have figured out. They're trying to free ride on everybody else's effort. And this is where we run into that core problem all over again. See, if the price was a perfect, crystal clear signal, the uninformed folks would instantly know everything the informed people just paid good money to discover. The value of that expensive research would just plummet to zero, nobody would pay for it, and the entire information market would just collapse. So for this whole system to actually work, for both informed and uninformed traders to exist together, there has to be some kind of secret ingredient, something that stops the price from being a perfect signal. And that secret ingredient is noise. Think of it like static on a radio signal. It's all the random stuff that messes with the price. It could be a huge fund selling off shares just because they need cash for something else, or it could be random shifts in supply and demand. This noise makes it impossible for the uninformed to know for sure if a price moved because of real news or just because of the noise. Now, here's the crucial part. This noise makes the price an imperfect, kind of blurry signal. It reveals some information, but it doesn't reveal all of it. And that little bit of imperfection, that slight inefficiency, is exactly what allows the informed traders to earn a return for all their hard work. And this brings the whole market into a sort of equilibrium. It's a really delicate balancing act. The profits that the informed traders make have to be just enough to cover the cost of getting their information. I mean, if the profits were any higher, more people would jump in and pay to become informed. But if they were any lower, nobody would bother at all. All of this leads us to the paper's most revolutionary idea, a completely new reality for how we see financial markets. It's not a state of perfect balance, but rather a balanced state of disequilibrium. The authors themselves called it a model with an equilibrium degree of disequilibrium, and that is such a profound shift in thinking. It means a perfectly efficient market is not just unlikely, it's a logical impossibility. The natural state of a market is actually one of slight, persistent, and totally necessary imperfection. And here it is. This is the beautiful, paradoxical punchline of the entire paper. For markets to work at all, prices have to be just inefficient enough to reward the very people whose constant search for profit is what makes prices efficient in the first place. So why does all this matter? Well, this paper completely changed how we understand markets. It teaches us that information isn't just out there for free. It's a valuable economic good that has a cost. It proves that a little bit of inefficiency isn't a bug in the system, it's a necessary feature that allows the whole thing to run. This idea reshaped how everyone, from academic economists to traders on Wall Street, thinks about what really makes markets tick. And this brings us to one last really provocative question, especially for the world we live in today. The whole Grossman-Stiglitz model is built on the idea that information is costly. But what happens to this delicate balance in an age of AI and instant global communication where the cost of information is just plummeting towards zero? What does that mean for the future of our markets?